Hi, folks. This is Big Mike Zlotnik, and today we're going to discuss the recent Labor Department report of 517,000 new hires in January. And one of the most important comments that I wanted to make is that it doesn't feel like a recession is here or it's coming soon, because we are experiencing pretty strong results of the hiring in January. Improved labor participation, improved wages. What's really amazing is that a good portion of the new jobs added were in the leisure and hospitality. It feels like the consumer is still strong. Consumer is still spending dollars, traveling, going to restaurants, have a good time. This is a result of pent-up demand of COVID shutdowns. We're still experiencing this. Now, it doesn't mean we will not see a recession later this year. There's still substantial time and expectation of recession in the second half of 2023. Nonetheless, we saw pretty robust employment data. The unemployment rate dropped to 3.4%. That is the lowest level in over 50 years. It's almost remarkable to have such full employment. What do folks do in this environment? Do they spend? Do they continue to travel? Do they continue to invest? So on the investment front, there's been a lot of uncertainty. Stock market has showed substantial recovery in January of 2023. It started the year extremely well, all in the expectations that the interest rates, long-term interest rates, especially 10-year Treasury, will continue to climb down. 10-year Treasury demonstrated a substantial retreat from its peak of about 4.25% in October, and then retraced it in November 2022, and now it's back down to about 3.5, 3.6% rate range. It's fluctuating a bit, but the expectation of inflation is certainly coming down. We've seen slowing inflationary data, and as a result, long-term 10-year Treasury note has been yielding lower rate. So looking forward, what happens? Where does fresh capital go in real estate? Just a couple of quick thoughts on this subject. Well, the fresh capital is very cautious right now. So the cautionary expectation is still there. This labor report, certainly good news for the economy. Nonetheless, the forward outlook is such that this will not continue and repeat in February. And by the way, we saw these spikes, the labor market reports that have spiked a couple of times last year. February 2022 and July 2022, there were substantial jumps in new employment data. So that is, let's just call them, each one of these reports is a positive surprise, but the trend is still down over multiple months. So I would expect in the upcoming months somewhat slower hiring, inflation tamming down gradually over time, and the 10-year Treasury retreating back down to 3.5 and below percent range. And then real estate deals, we and many other investors are looking for great deals, and the hope that there will be better deals later this year. And we're all getting ready, preparing, and so should you and many other investors. Obviously, great caution is required, but the opportunities are coming. Better opportunities are coming as a result of this recession. Recession is delayed, but it's not going to go away. It's long overdue. There's some theory that the recession should have taken place in 2022 because of the COVID, but that recession was very, very short-lived. And in fact, we are maybe now beginning to move in the direction of this long overdue recession. Although, as I said, it doesn't feel like a recession anytime soon, or it's not happening today. So appreciate your time and attention on this short video. We'll chat more again, and have a great day.